Have you looked at the financial news lately and thought to yourself, how has the economy not completely collapsed yet? Because honestly, you are not crazy for wondering that. Welcome back to Mary Invests. Look, we are living in a really weird time right now. We have got tariffs being announced, canceled, and brought back again. We have got massive national debt, political chaos, and inflation that still stings every time you go to the grocery store. Normally, this kind of turbulence would send the markets into an absolute tailspin. But instead, the stock market is hovering near all-time highs, and GDP is still growing. So today, we are going to look past the shiny, happy headlines to see what is actually holding this whole thing together. We are going to talk about the hidden warning signs you need to know about, and most importantly, how you should be protecting your money right now. Hit that like button and let us get into it.
All right, let us talk about the big headline number, GDP. Recently, it was reported that our economy was growing at an annualized rate of over 4%. Sounds amazing, right? Well, we have to look at why it is growing. Right now, artificial intelligence is doing almost all the heavy lifting. Tech companies are dumping mountains of cash into AI infrastructure and computer chips. It is basically doing the landlord special, painting a fresh coat of white paint right over the structural cracks in our economy, so everything looks fine on the surface. But here's the crazy part. Despite all those trillions going into AI, overall investment in the economy actually shrunk slightly. How does that make sense?
It is, because everyday businesses have stopped producing. Instead of making new goods, they are just selling off old inventory that they hoarded in their warehouses before all the tariff drama started. So AI spending is just barely masking a massive decline in actual everyday business production. If the AI bubble cools off even a little bit, those underlying cracks are going to become very obvious. Next up, global trade. If you look at the raw numbers, our trade balance looks fantastic. We are importing less from other countries and exporting way more. You might hear that and think, awesome, people are buying American. I hate to be the bearer of bad news, but that is an illusion.
We are importing less because, like we just talked about, businesses are just burning through their old backroom stock. But what about the exports? Well, our exports recently jumped by $26 billion in a single year. But a staggering $18 billion of that jump came from exporting just two things: gold and silver. Foreign countries and global investors are terrified. They are trying to get away from the US dollar and into hard, safe haven assets. To put this in perspective, on paper, our trade numbers look super healthy. But it is kind of like telling your friends your personal budget is doing great because you stopped buying groceries to just eat canned beans and you sold your car for cash. Yeah, your bank account looks full today, but it is definitely not a long-term strategy. Now, you probably know that the U.S. economy is driven by us, the consumer. And right now, consumer spending is supposedly keeping our economy afloat. But we have to ask who is spending and on what. First, a record amount of the spending is coming from the wealthiest households who are just riding the high of the stock market. Second, everyday consumer growth is not coming from people buying fun things like new cars or vacations. It is almost entirely coming from healthcare and pharmaceuticals. People are spending more because healthcare is getting more expensive, demand for pricey weight loss drugs is surging, and a lot of folks are rushing to use their health insurance out of fear they might lose it soon. This is not a confident middle class treating themselves. It is forced survival spending that you literally cannot say no to. And finally, we have to talk about the silent wealth killer, the shrinking dollar. Our economy may have grown on paper, but the US dollar has recently fallen by over 10% compared to most other major currencies. This quietly inflates our stock market highs.
If your portfolio goes up 10%, but your dollar loses 10% of its global purchasing power, you have not actually gained any real wealth. Add the tariffs on top of that, which studies show are overwhelmingly paid for by you and me at the checkout counter, not the foreign countries, and the middle class is feeling the squeeze more than ever. So why has it not all collapsed? Simply put, the U.S. economy is a massive, incredibly privileged ship. It takes a long time to steer it, and it takes a long time to sink it. For us as investors, this means we cannot get lazy. Do not let flashy GDP numbers trick you into complacency. Make sure your portfolio is truly diversified, keep plenty of cash flow on hand, and invest in companies with real, solid earnings, not just the latest AI hype. Thank you so much for hanging out with me today. If this breakdown made sense to you, please hit subscribe, leave a comment below with your thoughts, and share this with a friend who needs to hear it. Keep investing smart, and I will see you in the next one.